Welcome to the Trade Savvy Academy Options. Trading presents a distinctive chance for investors to capitalize on their market knowledge, enabling them to benefit from price fluctuations while creatively managing risk. After I clarify the concept of options trading, we will explore some examples in the later section of the video. If this video feels a bit confusing at first, don't stress. It's completely normal, especially if you're just starting out with options trading. Mastering this skill requires time, patience, discipline, consistency, persistence, and a commitment to ongoing learning. What is options trading? Options trading involves the buying and selling of options contracts, which are financial instruments that give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, before or on a specified expiration date. Options are classified into two main types: call options and put options. Call options. These give the buyer the right to purchase the underlying asset at the strike price. Investors typically buy call options when they anticipate that the price of the underlying asset will rise. Later in the video, I will go over an example of a call option. Put options. These provide the buyer with the right to sell the underlying asset at the strike price. Investors usually purchase put options when they expect that the price of the underlying asset will decline. Later in the video, I will go over an example of a call option. Some of the key components that make up an option are underlying asset. This is usually a stock or other security that you can buy through the call option or sell through the put option. Apple, Amazon, Netflix, Google are all examples of an underlying asset. Strike price. The fixed price at which you can buy or sell the underlying asset. Expiration date. The date by which you must sell your option or let it expire worthless. Premium. The cost of purchasing the call option itself, paid up front to acquire this right. In a separate video, I will cover how options are priced. Two different stocks trading at the same price can have different priced options for the same strikes. Options trading allows investors to implement various strategies based on their market outlook, whether bullish, bearish, or neutral. It can be used for speculation, income generation, and hedging against potential losses in other investments. Now let's move on to the second part of the video, where we cover why does options trading exist. Options trading exists for several key reasons. Leverage. Options allow traders to control a larger amount of an underlying asset with a relatively small investment. This leverage can amplify returns if trades are successful. I will make a separate video covering this topic later, so don't forget to subscribe. Flexibility. Options provide various strategies that can be tailored to different market conditions and investor goals. Traders can use options for income generation through strategies like covered calls or cash-secured puts, or for hedging purposes to protect against adverse market movements. This topic also requires a separate video which will be available on my channel. Risk management. One of the primary purposes of options is risk management. Investors can use options to hedge their portfolios against potential declines in value, similar to how one might insure property against loss. Speculation. Traders often engage in options trading as a way to speculate on future price movements without needing to invest directly in stocks or other assets. This allows them to potentially profit from both upward and downward movements in prices. Market efficiency. The existence of options contributes to overall market efficiency by providing additional avenues for cheap price discovery and liquidity. In summary, options trading serves as a versatile tool for investors seeking leverage, flexibility, risk management, speculation opportunities, and enhanced market efficiency. Now let's go over an example of a call options trade. To illustrate a call options trade, let's consider the following scenario involving a fictional company called Ricky Innovations. Step 1. Market analysis. Suppose you believe that Ricky Innovations is about to release a groundbreaking product that will significantly increase its stock price. Currently, the stock is trading at $50 per share. Step 2. Choosing the call option. You decide to buy a call option with a strike price of $55, expiring in 1 month. The premium for this call option is $2 per share. Since each options contract typically represents 100 shares, the total cost for purchasing one contract would be $200. Here's a detailed breakdown of the calculation. Total premium equals premium per share times number of shares. Step 3. Executing the trade. You purchase one call option contract for Ricky Innovations, paying $200 as the premium. Step 4. Possible outcomes at expiration. If the stock price rises above the strike price, Let's say that by expiration, Ricky Innovation's stock price rises to $70. You can exercise your option and buy 100 shares at the strike price of $55. Your total cost for acquiring these shares would be $5,500. Simply calculate the strike price times number of shares. You then sell these shares at the current market price of $70. In this case, $7,000. Your profit from this trade would be calculated as follows. Profit would equal revenue from sale minus cost to buy shares minus total premium paid. In this case, leaving you with $1,300 profit. If the stock price does not rise above the strike price, if by expiration, Ricky Innovation's stock price remains below $55, for example, it drops to $48, you would not exercise your option since it would not make sense to buy shares at a higher strike price. In this case, your loss would be limited to the premium paid. Conclusion. In this example, buying a call option allowed you to leverage your investment in Ricky Innovations, providing significant profit potential if your prediction about the stock's rise was correct, while limiting your losses if it did not perform as expected. To illustrate a simple put option trade, let's consider the following scenario. Step 1. Understanding the basics of a put option. A put option gives the holder the right, but not the obligation, to sell a specified amount of an underlying asset at a predetermined price, the strike price, before a specified expiration date. Step 2. Setting up the trade. Imagine you are interested in company XYZ, which is currently trading at $50 per share. You believe that the stock price will decline in the near future. To profit from this potential decline, you decide to buy a put option at a strike price of $45 with 1 month left to expiry at the cost of $2 per share. You purchase one put option contract, which typically represents 100 shares. Therefore, your total investment or premium paid for this option would be calculated as follows. Premium times number of shares, bringing your total cost to $200. Step 3. Possible outcomes at expiration. Stock price falls below strike price. If company XYZ's stock price drops to $40 at expiration, you can exercise your put option and sell 100 shares at the strike price of $45. Your profit from exercising the option would be strike price minus the current market price multiplied by total number of shares and subtracting the total premium paid, which brings your profit to $300. Second outcome, stock price stays above strike price. If company XYZ's stock price remains above $45, for example, it stays at $50, the put option would expire worthless, since there is no benefit in selling at $45 when you can sell at market value of $50. In this case, your loss would be limited to the premium paid of $200. Third option would be the break-even point. The break-even point for this trade occurs when you can recover your initial investment through exercising the option. This happens when market price equals strike price minus premium paid. Thus, if company XYZ trades at $43 after 1 month, you would break even. In summary, buying a put option allows you to hedge against potential declines in stock prices while limiting your risk to just the premium paid for the option. This example illustrates how put options can be used both for speculation and hedging purposes depending on market movements. Remember, you can sell options at any point during market hours before they expire. It's a common misconception that you must hold on to the option contract until the expiration date. If you think the stock has reached your target price, you have the opportunity to secure your profits. Conversely, if you feel the stock isn't going to perform as you initially expected, you can adjust your strategy and exit the trade, whether that results in a profit or a limited loss based on the current stock price. If you enjoyed this video, make sure to give it a thumbs up and subscribe for more educational content about the stock market. Got any questions? Just drop them in the comments.